Welcome to Market Matters. Today is May 5th, and nice to see everybody again, virtually, I guess that is. As with most Market Matters, I would just encourage if you have any questions along the way, please feel free to drop those into the chat feature of Zoom. I'll try to grab those as they come in and address them when the appropriate slide allows me to do that. And if there's any questions that I can't answer at the time, we'll certainly follow up with you afterwards in a personal message and connect with you that way. In addition, all cameras are going to be turned off just for the remainder of the discussion, just so we don't have any distractions along the way, and mute as well. So with that, let's get started. A little bit longer agenda than we normally have. We're actually just playing with, changing up the agendas a little bit from time to time to keep it a bit more interesting or updates more relevant. As with prior meetings, we'll touch on COVID because that's still a part of all of our lives, I think, for most of us at least. Touch on the economic situation briefly. Looking at our investment outlook, which is just had some minor modifications since last we spoke in last month. We'll also touch on the special topic this session, which is a summary of the proposed tax law changes, which we've been getting a lot of questions about that from clients and potential clients. So I think this is just be a great opportunity to touch base on what those changes look like now with one of our wealth advisors, Scott Rutherford. And then finally, I'll just make a note, touch briefly on what's happening with Marathon Value Portfolio. That's the mutual fund that we run internally, and some next steps with that. So along those lines, let's get started. So turning to the COVID situation, I think it's a tale of two cities to some degree, where we've got, in the US, of course, the situation looking very promising with case counts, starting to decline, or at least level off for that matter. But more importantly, the percent of the population continues to rise that's vaccinated. And I think President Biden has a goal of his administration to get to 70% with at least the first vaccine for the entire US population. And we'll touch on that on the next slide. But I think globally is a bit more of a mixed picture, because globally the situation is not looking so great, particularly in developing markets, markets that are not, having access to, excellent healthcare systems or drug development and production. You can see here globally, because of what's going on in India, most prominently, you can see a massive change in new cases in India, up to 368,000. And Brazil, which just can't seem to shake some of the issues they have with their management of the COVID. This is where we've got a little bit of a spike up or move up in new cases globally. So last month, the number of new cases, was right around 550,000. Today, we're at 674,000, which is not necessarily a positive development. And so we'll just have to see how that the variants are, of course, what's the problem here. And it could very well end up being that this is similar to the flu. We treat this like the flu, just a bit more deadly version or variant. But it's something we'll have to just keep an eye on, because if they can't contain some of these case counts, then that may impact global growth, regional growth, and we'll have to take note of that for sure. But in the good news side of things, the U.S. distribution system is working pretty well, and you can see we're approaching this, 30 to 35% of U.S. population having been vaccinated, starting from January at 0, and moving to where we are today at roughly 30 to 35%. So that's definitely a positive, development, trending in the right direction for sure. And then also, the new case counts per million is trending down into a much lower level, 7-day average here. So, does that mean we could reach the, theoretical threshold of 70% herd immunity in roughly 3 months? It could be a bit of a stretch for sure. Could we ever is maybe a better question, given some of the variants. But I think the fact that we're getting most of the vulnerable population access to these vaccines is really critical. And we'll kind of take it as it comes with some of the less vulnerable populations. But this is all good news. One reason why you'll see in a moment economic growth in the U.S. is set to take off here shortly. So now that we talked about, COVID, how that's kind of influencing some of our thoughts, particularly around international investments, we'll look at the economic update here in the US. And I think I showed this last month, and this has been something that, I've been showing in these market matters for probably the last 3 or 4 months. And that is the wealth effect should not be understated as a very powerful driver of consumption and demand. And wealth effect basically meaning if the price of your single largest asset, for most people that's their home, is going up, that just makes people feel better about the world in general, life in general, wealthier to some degree, and that has a way of making people want to spend a little bit more at the margin. And so I think, price gains of 12% shouldn't be expected, forever or in perpetuity. But I think in this time around, very dissimilar from the mid 2000s, that prices were being pushed up by, a lot of speculation. Certainly there's some speculation now, but you see, I think what really makes this 12% move in prices palatable, or not palatable, but reasonable, is that we are at the all-time lowest level of inventory of new homes that's ever been recorded. I think there's something like nationally, something like 600,000 homes for sale, which is on a population of 350 million. That's not a lot. And you can see where, I'm sure in your own circles, you've noticed the same thing as well, that, prices are going higher. Days on the market are, very low. I mean, 1 to 2 days in Decatur, where I live, is not uncommon. And above market or above marketed price bids are not uncommon either. So this is a good thing. I think it's a wealth effect that's creating a positive cycle here. In addition, not only do we have positive gains in housing, but also just in general, the U.S. economy is recovering from a very sharp and quick recession. So the recovery is going to be pretty sharp as well. And that's what you're seeing on the chart in front of you, which is, this came from Goldman Sachs. So this is one estimate. You can see the Goldman numbers in blue here, and the consensus, meaning what the rest of Wall Street is thinking, is in the black dot here. But you can see coming into Q1 is estimated to be somewhere in that 5% range, maybe even 7, as high as 7 once all the tabulations are in. Q2 is going to be just a monster quarter. I think one of the biggest quarters the U.S. economy has ever had, estimated to be 8, but potentially up to 10.5 by Goldman, and then trending off and down more towards this lower level. So, I think I frame it out this way. I'm calling it the pig and the python, as it's working, as this growth pulse is making its way through the pig, or the python. But, really massive growth ahead of us for the next couple of quarters, but trending down towards the more normal rate of growth in the U.S. economy, which is in that 1.5 to 2% range. So, how do we prepare for that? And we'll touch on that in just a moment. I think one upside that most people aren't thinking about right now is, what happens if Europe gets better? Europe, the Eurozone in particular, you're seeing on the chart in front of you, this is a picture of the Eurozone economies all aggregated together, the good with the bad, of course, that they've kind of trailed off in growth estimates of expectations. Q1 was a negative growth quarter. You may have seen that come out from, I think it was the New York Times published that story. But what happens if we actually get a positive growth quarter? So you could have a very positive global situation if you have both the US and Europe recovering at the same time, as opposed to moving in different directions like we have been for the last couple of quarters. So I think that's one upside surprise that maybe some folks aren't considering, where we could have just a blistering Q3 globally. So how does this all translate into the investment outlook? And it's, as you might imagine, it's a bit prickly in some cases, but also not as prickly in others. So yeah, I think just generally speaking, with price levels in stocks where they are, we have, as part of our process, started to raise cash levels in very small amounts again. Recall that we started doing this in Q3 of 2019 ahead of COVID, because the markets were going up and earnings weren't changing. This time around, we do recognize that equities are on the high side of valuation on average, but there are positions that are trading above our target prices, and we're being active around trimming some of those positions. And some of those positions we trimmed earlier in the year, which has led to some portfolio turnover, which I think was well timed, was trimming back our U.S. large cap growth positions that did exceptionally well last year, and adding those positions, basically starting to add to that cash position for the first time, in about 10 months. From an asset allocation perspective, I mentioned this last time, but we did, as an investment committee, adjust downward and incrementally all of our fixed income holdings in favor of what we call alternative income positions. And really, these are positions that have really no bearing on what the interest rate markets are doing. And the reason we did that, the impetus for that, was because I think at the time the 10-year Treasury was coming off a 60 basis point level up to 70 or 80, and we thought the incremental upside in bonds just wasn't quite there at the time. So as I mentioned here, moving to the equity section, we are actively trimming positions back, dropping those proceeds into placeholders, generally speaking. And then at the individual strategy level, for those clients that own our dividend strategy, we've been pretty active about adding to what we perceive to be undervalued single names, single companies. And some of those have resided in the commodity and energy sectors, and those have worked out quite well this year. Fixed income wise, this is, I think, we're maintaining the strategy we've had for a little while now, which is keeping a higher quality approach to this part of our portfolios, keeping a little bit shorter duration on average than maybe the index. And the idea is here to preserve capital so that when potentially equity markets do decide to break loose to the downside, that we're ready to capitalize on the opportunities that are in front of us. And I did want to point out, we just do not believe still that it's worth chasing, some of the yieldy sectors of fixed income right now, because really to get any sort of substantial yield in fixed income right now, you're having to delve into sectors that have very poor return profiles ahead of them. Things like high yield bonds or preferred stock just don't have a lot of utility right now when they're trading at some of the lowest levels in yield they ever have. So it's just part of our, objective, I think, management process here, where we're saying we don't have to own things that exist just because they exist. And then finally, alternative positions. This has been a bigger allocation for us in recent times. We are looking at, on the growth-oriented side, positions that can benefit from volatility, and also positions on the income-generating side that can sustain that income level at the portfolio that's not entirely correlated with fixed income. So that's a brief overview. Let's talk about some of these sections in a little more detail. So here's our investment ratings. No real changes since Q1. We still have a bias towards large cap US. Continue to search around for some mid cap opportunities. That would be one area that we're looking at. We continue to see some opportunities in active strategies on the developed market and emerging markets side. So, on average, our average account has a roughly 30% allocation to international stocks. It's probably as high as it's going to go for the foreseeable future, but there are reasons to own international positions. Bonds, we've downgraded bonds across the board to a slightly unattractive positioning, which is why we downgraded or made those position adjustments back in January and February in the favor of what we do find more attractive, which is alternative strategies, which are a bit more attractive because they don't have the correlation to interest rates that you might find in the bond section. And I do think it's good to just touch on, foundational concept every time we do one of these webcasts. And it's easy to forget, but over long periods of time, this is one reason why we have a preference for dividend paying equities. And that's why it's one of our flagship strategy, the dividend growth strategy. It's because over time, dividends do account for, as the numbers would show, roughly 40% of the total return of the S&P. Now, obviously, recently, price appreciation, that's this gray bar here, accounted for a much larger percent of the S&P's total return. But, I think it's, certainly something we find attractive is a company that's able to pay a dividend is a validation that their business model is working and continues to work. And one reason why we think dividend stocks should be at the core of almost every portfolio, because they have some of the staying power attached to their business models that you don't find in a lot of other companies, particularly like high growth non-profitable growth companies. And as for markets, this is how we ended up so far in Q1. This is year-to-date picture. And this is through Q1 obviously ends at March 31st. And then we just extended it out to April 30th. And you can see some things that emerged here that I think are actually pretty positive. One is that large cap, the S&P has actually caught back up to the Russell 2000 small cap index. Although the small caps having a better performance is actually a good validation that there is some sustainable economics, growth in the pipeline, and that certainly is something that we think is good to have as a tailwind for sure. And then international stocks, yet again, are in aggregate underperforming the S&P and Russell 2000. One part of the reason why we do have an underweight relative to U.S. companies in our strategies. And it's likely going to stay like that until we can identify a good solid reason to make them a more equal weighted position. But this continues to be something that's working for us as our US large cap overweight. And we're, as I mentioned, we're looking at some of the companies that are strategies in the mid cap space that can give us a little bit of the extra upside that we're looking at. And what's driving stocks? I mean, I know this is maybe sounds kind of hard to believe to some degree, but maybe it's just the data hasn't been presented this way sometimes. But with valuations on the S&P, I think the forward-looking price to earnings ratio, that's just a measure of valuation, is at some of the highest levels it's been in a number of years. It's in the 20s on the S&P. But what's driving that is, I think expectation that companies are going to do well and do better in the future. And what you can see is so far of the companies that have reported earnings in Q1, I think we're actually almost all the way through Q1 earnings. We're getting close to it. 86% of the S&P 500 companies are beating the estimates, and not only beating them, but beating the estimates by a fairly wide margin, particularly in places like information technology, but also in some of those more boring value-oriented sectors like financials and energy. You can see 93% of financials, 92% of energy companies are beating their earnings estimates. And this is actually a very powerful driver and makes sense to me why value has actually started to outperform a little bit relative to growth. And that's because a lot of these value-oriented companies have a way of not only taking advantage of potential inflation, but also their business models are doing exceptionally well, particularly now that oil prices are back close to 70. And in the case of financials, the yield curve has been pretty steep, so they can make money by paying all of us almost nothing in our bank accounts and lending out at rates that are 10 times higher than what they're paying us. So this has been something we've been looking at and trying to understand why. And if you ask me, I think valuation wise, it makes sense why the S&P is trading where it is. Furthermore, you combine this growth in earnings to actually an improvement in profit margins. So not only are they generating higher levels of sales that the S&P 500 companies had from this point last year, earnings are higher. Part of the reason earnings are higher and could potentially go higher still is based on margin improvement. So this is just a look at profit margins all the way back to Q4 of 2016, and you can see they've done a massive job of improving from the 8.6 we were in Q2 of last year to almost at the trend level of 11.6%. So profit margin growth is certainly supportive of valuations that are at this level, because you've got not only growth in earnings, but part of it, that growth is being driven by margin improvement. And that's usually a good thing for equity investors. So looking at fixed income, I'm just calling this stuck in neutral, and this is probably where we're going to be for a little while in fixed income, because we had the worst start, the third worst start to the bond market in years. I think it's actually back to the 1920s. And a pessimistic narrative has been built up around the asset category. And I think, this may be a little premature, because what has happened in history is BlackRock. I don't know if we have it in the presentation today, but after a really sharp sell-off in the first 3 months of the year, what tends to happen on average is you get a very nice recovery in the back half of the year. And what that would mean is bond yields would go lower, in the back half of the year. And that you might say, well, that's a little strange. Why would that occur if you have all this growth in front of you? Well, remember that the markets are a discounting mechanism across all markets. So whether it's stocks, bonds, commodities. And what it means to be a discounting mechanism is that you look into the future, and maybe what the bond market is seeing, and one reason why we're having a hard time getting off of the levels we're at right now is one of this is the employment picture. So even with all the job gains we've had recently, what this is showing you is the percent of the U.S. population that's actually employed. And you can see from the peak of February at 61%, we're still only back at roughly 57%. And what this translates into is about 4 to 5 million jobs that still need to be, taken up to get to that level of unemployment. So lower levels of employment are not suggestive of sustainable inflation and therefore higher bond yields potentially. And additionally, I showed this chart last time, which is what is the market expecting for inflation 5 years from now? And the way you derive that is by looking at what they call the 5-year forward inflation expectation rate. And what the market is saying right now, I showed this last time, is that in 5 years, inflation will be around 2.3%. Now, this can obviously be wrong. And there's plenty of times when it has been, but even the market is saying, well, maybe temporarily we're going to have some inflation that's pretty massive, but longer term, that may not be the case. And, I just show this chart here, and this chart asks the question to a sample of adults: how concerned are you about, inflation and the costs of household items or your household expenses? And, when people are concerned about inflation, if everyone's on one side of the boat, I always like to say, what could go wrong? And maybe this is sustainable inflation in front of us, but we're not taking a hard position on that quite yet, because I think there's a lot of narrative out there that has yet to manifest itself. So just some takeaways here, similar to last time. We do prefer, equities over bonds or stocks over bonds, particularly if you look at our capital market forecast, which we've started publishing for those that would like to see it. Alternative strategies, we've moved into those versus bonds, like straight, fixed rate government bonds. And we think that was a good allocation shift that has added value for sure. We did start adding some cash again to the portfolios, and you start seeing that build up, not a lot, but as the market goes higher, we'll certainly use those opportunities to add cash. And then finally, I would just say we're not terribly concerned about inflation yet. Certainly commodity prices are signaling there is some inflation on the horizon, but we're going to take a more measured approach and wait for some confirmation for some of that to come through. So with that, that concludes my prepared remarks. And I did want to make sure we built in some time for our special guest, Scott Rutherford. For those of you that don't know Scott, Scott is a wealth advisor at Gratus Capital. Scott also carries the distinction of being a practicing CPA. He's got a tax practice that he's been run alongside his advisory practice for a number of years, having been a former partner or a managing director, I think, at KPMG. So a very great name to get on to talk about the topic that's in front of us, which is, what are some of the proposals coming down the pike for the tax proposal that President Biden has put into, laid forth in front of Congress. So Scott, if you, there you go. If you want to join us now, why don't we do this? Why don't we just take a look at some of the proposals by category, individual, state, and then corporate, and then we can take it from there. Why don't we bring us up to speed on the individual here?
Thanks for letting me join. There's an awful lot going on in the tax world these days, and every time you look around, there's either the president's proposing something, or there's Senate bills that are being proposed, and so there's just a lot of movement in the news these days. And what we'd like to do is just try today to bring out some of the highlights of things that are going on, how we can plan perhaps. And so we've heard that where Social Security tax, again, President Biden wants to hit the higher income earners. And Social Security tax drops off right now after you've reached earned income of $137,700. He wants to reinstate that for those that are making $400,000 or more. So there's a kind of a donut hole between that $137,000 amount and $400,000. But then once you get above $400,000, it kicks back in again. There's also a lot of talk about the individual income tax rates moving up to 39.6 once you get over $400,000. Well, the press would have you believe that you're already at the 37% bracket, which is the highest bracket, and moving up to 39.6. But in 2021, tax rates, if you're up to 414,000, you're still in a 32% bracket. Then you move to 35% bracket for the next couple of $100,000, and then you get to that 37%. So again, anywhere between $400,000 and $620,000, you're going to have a significant increase in tax when we look at what the proposals are. Proposals for long-term capital gains and qualified dividends being taxed as at the same level as, say, your interest income and your non-qualified dividends, potentially could be just taxed for those that are making over $1 million. But then it also could be, again, in the negotiation stage, could wind up being those that are making over 400,000. We just have to watch that and see how the legislation comes out as time goes on. Could be that you wind up, I've heard some negotiations talking about rather than a 20% rate, going to a 28% rate, but then you have to add on to that the 3.8% Medicare tax. So you're really at a 31.8% versus the 23.8% now. The state and local tax deduction is something that is a very hot topic. You'll recall that several years ago, was a $10,000 limitation put on that. And the folks in New York and California, states that have much higher tax rates, I think California is as high as 13.3. They were severely limited by that. And in fact, I was reading earlier this week that if you were to remove that state and local tax deduction and put it back where it was, it's about a $600 billion cost that when we're writing tax law, that has to be made up some way, somehow. Other thing that's being thought of is, well, if we do put that SALT deduction or remove that limitation, then maybe we limit the number of itemized deductions you get to a 28%. So instead, even if you're in the 39.6% bracket, you're limited to a 28% benefit. And years ago, we had a limitation that's called the PEASE limitation, P-E-A-S-E, where you got a 3% haircut depending on what level of income you were. Some of your itemized deductions got cut away. For pass-through entities, if you're a pass-through owner, many people get a qualified business income deduction, and that's 20% of that pass-through income. That is up for negotiation or elimination. Then I thought what was real interesting was as we talk about the effective date of when this might go into play, I was thinking, and some of my readings said that it could be potentially January the 1st, 2022. Well, then you look at other people that are writing and say, well, parts of this could actually come into play on the date of enactment, the date it's signed by the president. A lot of negotiation has to happen between the Senate and the House and then the president, and whenever it's signed, that could be the date of enactment. But then other things that I read said that, well, it could be that things like the capital gains rate change could apply once committees vote on it. So we just really don't know exactly what the timing on these are going to be, but it will be interesting to walk through to stay abreast of. Some of the planning ideas that are kind of out there, maybe you just accelerate some qualified, some charitable deductions to get under the, while you have the opportunity at a higher tax rate. If this state and local deduction changes and it becomes unlimited, well, maybe you don't make your state estimated payments now in 2021, you wait and pay them in April when you file your tax return for the year 2021, and you get that deduction when you have a much bigger opportunity. It'd be a deduction for the 2022 year, but thoughts about doing that. We're going to be considering, do we go ahead and accelerate capital gains into 2020 2021? Do we delay loss harvesting until 2022? Those kind of things. So Todd, that kind of covers that particular slide. Anything you had?
Yeah. Well, I'll talk on just a minute about some of maybe the ways we'll address this on investment perspective, but maybe we can move on to the next area of changes, proposed changes, which is the estate and gift tax.
Okay. Again, the estate tax exemption right now, it became $11 million. It's increased by inflation up to about 11.7 million for each person, meaning that a married couple has was that $23.4 million of assets that are not subject to an estate tax. Years ago, it was at 3.5 million. Then it was changed to 5 million before it went to the 11 million. And so some of the charges will go back to the $3.5 million number. Maybe even we negotiated 5 million. We just don't know at this point. But something to be considered there. One of the things that is getting a lot of headline is the stepped up basis that when a person passes away, the basis in their assets stepped up to that date of death. A couple of things that are being bantered about are just either eliminating that, or at date of death, all your capital gains are triggered, or perhaps you wind up with a $1 million exemption related to that, as opposed to a full step up. You get $1 million that you can protect by stepping up the first million, or maybe that becomes a $3 million number. We don't know. But it could be interesting. So if somebody's in a higher estate situation and your capital gains are triggered at death, and if they're at even a negotiated 28% rate plus a 3.8% rate for the Medicare tax, and then you're taxed at a 40 or 45% estate tax rate, all of a sudden those capital gains are at a 76 or 77% tax rate. So not a good thing to have. Things that we'd really need to be planning around. The next bullet says the estate tax rate currently at 40%. They want to increase that to 45, but then instead of it being a flat rate, go on up to 50 to 55 to 65 as your estates get bigger. And the 65% is for those that are $1 billion and up. But again, subject to negotiation, we'll see where that goes. Some of the planning tools that they're talking about eliminating, and right now, a number of clients have entered into short-term grats or grantor retained annuity trusts that have a 2-year life. And in the appreciating, or the way the stock market has performed recently, those 2-year grats have performed very, very well. Well, they want to get rid of those and have something, maybe leave the grat in place, but have a 10-year life to it. The GST deferral, that's the generation skipping transfer tax. Right now, there are planning opportunities where we call them dynasty trusts, and you can limit that GST exposure for a number of years. Now they want to limit that to maybe a 50-year lifetime before that gets taxed. Senator Warren wants to put her annual wealth tax in place. And then two, we also advise clients on the gifting world to go ahead and be gifting to heirs, friends, whatever it might be. And you're aware that there's a $15,000 a year gifting exemption. So you can gift to anybody that you want to, $15,000 a year. If you're married, you and your spouse can gift a total of $30,000 per year. And there's no reporting on that. In addition to that, there's a lifetime exemption that right now is at $11,700,000. So if you wanted to give away $1 million, you could do so and use your lifetime exemption, or excuse me, your annual exemption of $30,000, and then dip into your $11,700,000 exemption and not worry about any kind of gift tax. Well, some of the proposals that are coming out are saying, well, we're going to limit the amount of gifting that you can do to 2 times what the annual exemption is right now. So what that would say is, if I wanted to gift somebody $15,000 or to put in a grandchild's 529 plan, put in $15,000, and I've got 5 grandchildren, well, I couldn't do that. I could only do $30,000. So instead of giving 15 each, I would only be able to give 5 each for a total of $30,000. So that's gonna impact a lot of folks. So that's another one that we've got to be looking at. And then instead of the lifetime exemption being 11 million, that may ratchet back to $1 million. So just some interesting things that may be going on if the estate plan, if the exemption is discussed and is changed significantly way back. Well, we have the thought, kind of a morbid thought, but at December 31st, if you've got somebody that's on life support and they've got a very healthy estate, I'd hate to be in the heirs position of having to make a call. So I just not sure I want my clients on life support at December the 31st.
Yep. And then finally, Scott, we've got some thoughts that I know have been proposed here on the corporate side. And I think actually, we can, I can cover some of these here as options that, for us, as we look at companies, this corporate tax rate makes a big impact, as it did with the Tax Cuts and Jobs Act of 17. And, obviously feel free to add in your thoughts here too, but moving the headline rate up from 21 to 28. Scott, if I recall, prior to the Tax Cuts and Job Act of 17, that corporate rate was in the 30s. Is that right?
It was at 35%, but I've even though 28% is coming out in the headlines, I've already heard negotiations with people saying, well, no, it's probably going to wind up closer to 25%.
So not as bad as expected, right? And then some of this middle section talks about, overseas earnings. So I don't know if that's a big deal or not, but do you have any thoughts on that?
Back in 2017, there was a change related to there's a global structure, I guess, if you will, where companies have moved their trademarks, their patents, whatever it might be, any kind of anything that a royalty is paid on, they've moved that to a lower taxed country. Ireland, for example, has a 12.5% tax rate. So if a company in the US pays a $1 million royalty payment to its other company in Ireland, it gets a 35%, or it gets a corporate deduction, 21% deduction here in the US now. Ireland, it picks up income at 12.5%. Well, the US put something in place in 2017 that says we're going to tax everything at least at a 10.5% rate. And President Biden is trying to double that so that at least anything that is earned overseas in a lower tax state or tax country gets taxed back to the US at a 21% rate. Also wants to put the 15% minimum tax in based upon just book income. So as you report, as the companies want to report a higher income amount to be able to boost their stock price, well, there's going to be an impact there that they're going to pay a 15% minimum tax, whether they've got under tax law deferred items or whatever it might be. But I have seen the question coming up, well, who's going to be driving taxable income now? Is it going to be the auditors of the companies, or is the IRS? Who's going to be determining what that number is? And so I think as you look worldwide, there is this Organization for Economic Cooperation and Development is trying to develop a tax structure around the world where I think there's 159 companies that are involved in that trying to put something out there where everybody can kind of share in a same, not share the revenues, but at least have a similar structure so that we don't have as much tax shopping going on as we move around the world.
Yeah, interesting. Very good. And, I thought it'd be, good to just take a look at, when any of these big changes are being contemplated, 2017 obviously being the most recent one for tax lowering. But in the cases where the proposal is to raise capital gains taxes, that's happened 3 times in the last 30 years or so. 87, 88, and 2013, as this Goldman Sachs chart points out. What's been the experience with stocks in general? And like many things in the markets, there's a lot of anxiety into the decision. So, as Scott mentioned a few times, there's a to be determined aspect with a lot of this, right? Where We don't know exactly how it's going to come out. Therefore, that unknown creates some people to sell now and just wait to see what happens. So in the 6 months prior to a rate hike, the S&P is sold off somewhere in the neighborhood of 3 to 4%, which makes sense. However, once an actual decision happens and actually a bill is signed, the S&P tends to rally regardless of what really happened from how much the rate has risen. I mean, obviously there's probably some exceptions to that, but it's risen about 13 or 14%, because now there is a known set of rules around which the companies can adjust. And if there's anything that we've found with U.S. companies in particular, they are very savvy from a tax management standpoint. Had people formerly like Scott that were handling some of their affairs. So we've got, I think a big relief rally once this actually happens. So I guess the net of it is, we don't get too wound up about some of the proposed changes quite yet, because the rules aren't known in full. And there's a lot of discounting that goes into that, and a lot of negotiations to have between now and the actual outcome. And then finally, how does this really impact or manifest itself in earnings? This is the time prior to when the Jobs Act was actually signed. And the chart here just shows a progression of earnings estimates, into the actual decision. And what you'll notice is along this time frame, there was a little bit of a deceleration in earnings growth expectations, and that I think made sense because the economy was slowing a little bit. But it's really only until after the bill is signed, kind of dovetailing on to the prior slide, until it's actually signed, do actually estimates start to change and move up, right? So we shouldn't expect a whole lot until that happens, and then participants are going to discount those changes, immediately thereafter. So, we could still be a ways off, is my point. So there's not a lot of action that we would take at the moment, but certainly we'll be watching to see how that evolves. So I know we've gone a little bit longer than we normally do. There's a lot of good information in there that Scott shared with us. I would like to thank Scott for joining us and providing some of the information we reviewed today. These types of questions relating to estate and gift tax, but also personal, certainly please consult with your wealth advisor at Gratus, or tax professional, and we'll certainly be looking at these items on our side and providing advice where appropriate. So with that, I just wanted to thank you for joining us today. Look forward to speaking to you next month right around this time. Thanks, everybody.